Good day, everyone. My name is Paul Rosso with Remax Properties, and welcome to the Bucks County Homes and Living Show. I'm excited about our show today. My guest today is Joe Scorese from Third Federal Bank. We're going to be discussing the mortgage process, especially as it pertains to first-time buyers. And if you'd like to talk to us today or ask a question during the show, give us a call at 865-359-4232. So welcome, Joe. How you doing today?
Nice to see you.
Good to see you.
Excellent.
Definitely. Hey, so can you tell us a little bit about yourself? You know, where you work, what you do?
Well, I'm currently working at Third Fed Bank. I've been there for about 4 months now.
Okay.
Previously, I was at Continental Bank for about 3 years as a loan officer. I've been down in the greater Philadelphia market for about 5 years.
Okay.
I married about 3.5 years ago, so that was really the reason why I moved down here. And
excellent.
Kind of changed my market around. I was up in the Lehigh Valley area.
Okay.
And I've been down in, like I said, in the Philadelphia area for about close to 5 years now.
Okay. Now, are you a mortgage banker, mortgage broker?
We're a bank, Third Fed Bank.
Okay.
We're a mortgage banker. I mean, does everybody correspond with other affiliates to potentially get a loan closed? Yes.
Okay.
But primarily our focus is to bank as much of our loans as possible.
Okay. And what's the difference between, for the audience here, what's the difference between like a mortgage broker versus a mortgage bank? Is there any major differences there?
Well, there are some differences. I mean, with the new laws under Dodd-Frank and RESPA laws, brokering is more seen, it's more transparent. So, whatever they're making on the loan, they have to disclose that to you fully.
Okay.
Well, with the bank, we're working directly with either Fannie Mae or our own money, and we're not charging points. We're charging based on the yield of the rate, based on the current market of that day, based on the 10-year Treasury note for the most part is what we usually follow.
Okay. Now, today's May 8th, 2014, and what are the interest rates today going for about?
Right now, conventional financing, the rates right now are anywhere between 4.25 and 4.5 right now. They came down about 1/8 of a point in the past day.
Okay.
So things are looking pretty good. And same with FHA, about 4.25 to 4.5.
Oh, excellent. And so let's talk a little bit about the mortgage process. You know, I always advise people to, find a real estate agent they like and trust, and sit down with them for a consultation, and then also get, so you find out a little bit about what your affordability is going to be, work to get you pre-approved, okay, and get an idea on what type of house, what areas will work for you. The pre-approval will then give us an idea what your mortgage payments you can qualify for, and also that'll help us to, in turn, figure out what price range and what areas you can actually go into. So, is that kind of, what's your thoughts on that process? Is that a good process for people to start with?
I mean, sitting down with a realtor obviously is always important because you need to understand what neighborhood or community they want to live in.
Right.
And obviously the greater Philadelphia market is a compilation of neighborhoods and communities.
Sure.
Once you define those neighborhoods or communities that they want to focus on, and most likely it's related to school or taxes or things of that nature, you then have them speak with a loan officer, such as myself, and narrow in what their qualifications would be based on that neighborhood. That neighborhood, listen, you're not going to find a property for anything less than $200,000. So we know that we're going to have to try to qualify them for $200,000, and then we have to see what monies they have available, whether it's from their own or families, maybe gifting it to them.
Okay.
And then we come up with a pre-qualification or pre-approval. So they're a little more farther ahead than just a pre-qual, like we ran credit and took an application.
Okay.
I went out and approved them under Fannie Mae guidelines, left some of their documentation. But as long as their documentation matches up, that approval will hold tight.
Okay, terrific. And so, one of the things I know that a lot of buyers are concerned about, a lot of people who want to buy a house but don't go through the process, is their credit scores. Some of them don't have perfect credit. So, what kind of credit scores do you need to qualify for the different types of mortgages? What happens if you, what can you do if you don't have the best of credit?
Well, I mean, as you know, in the past 5 years, people have gotten, banged up a little bit with their credit and or responsibilities on debt, changing of jobs, losing jobs. Really, in this market, 620 credit score is really what you need to have or better. Are there banks out there or broker bankers that are saying they can do as low as 580? Great, they buy a house, but they can't afford to even get a credit card to buy a washer and dryer. So does that really make any sense to put them into a house poor circumstance? That's why FHA got into the problems that it has and almost went bankrupt, because they were giving loans to people that really shouldn't have a loan. They should be renting and fixing their credit, fixing your credit is working with somebody with credit repair or
Okay.
maintenance. I actually maintenance my own credit, and focusing on the line items and trying to keep your financial credit lines as minimized as possible, because we all have history.
Sure.
You know, we've been on this earth X amount of years, so the credit will reflect that amount of volume of business. What my credit repair company that I work with is they try to consolidate and keep what only needs to be on there, and eliminate everything else. And it keeps a very robust credit score. So I suggest anybody trying to, once they get their credit, know what it is always to maintain it.
Okay. And so if someone has, let's say they have a 580 credit score, and they, you know, what steps should they take? What are some of the easy steps they can take? You mentioned about it, going through a credit repair. Is there anything else they can do to try
doing it themselves? I mean,
Yes.
there could be some discrepancies on the credit that might be easily just a matter of calling the credit agencies. So the loan officer that they're working with at that time should assist them in getting in touch with the credit agencies to not dispute, but to clarify items on the credit. When you dispute an item on a credit today, that could hold up a loan for you.
Okay.
Banks will not close on a loan if a client has a open dispute on their credit report, because it could change the credit once the dispute is either released or consummated, because maybe they're disputing a credit card and they lose the dispute, so that credit will then go against them.
Mm-hmm.
So disputing is not the way to go. The way to go is communicating with the credit agencies, getting familiar with exactly what's on your credit report, and see if you really do need maintenance. I mean, you can try to do it yourself, but 9 times out of 10 people don't follow up and follow through with their credit.
Sure. Now, what happens if their credit's pretty good, but they have maybe an old medical bill, or an old, a lot of people have, gym memberships that, they never paid up. What can they do?
Great question, because just recently a family member, she had 2 collections, and she says, I don't know anything about these. They're medical payments. I never even heard of these companies.
Mm-hmm.
All I did was Google search the name of the collection companies. Guess what? There was the phone numbers. She called them. Guess what she did? She paid them all. One was $140, one was $84.
Mm-hmm.
Pay them off. It's affecting your credit by 40 points. And the longer it sits on there, it's like an anvil on allowing your credit to improve, not and stay where it is.
Mm-hmm.
So believe me, there's ways of finding these collection agencies. You just Google search them. That's why you have Google.
Yeah. Okay, terrific. And so let's talk about the mortgage process a little bit. Someone wants to, get started with talking to a lender, or they come in, talk to myself or another real estate agent as far as the process of buying a house, and they're getting ready now to go through the pre-approval process. What do they need in advance of talking to a lender?
What I tell people, and I just was on the phone on the way here, and I said, listen, what do I need to to put the application together? I said, well, what you need to know is if you own additional properties, what are the taxes and insurance for the year? What are the rents? Do you know what your real income is? Take a look at your tax returns. Take a look at your W-2s and or 1099s if you're self-employed. We need to see if those numbers match. Mm-hmm. Whatever that W-2 says is really what your income is for the year.
Right.
If you've changed job positions, we need to sit down and know what you made here and where you made in the other location, and we come up with a median.
Okay.
Between that year, then we take the median over 2 years. So currently we're looking at 2012 and 13.
Okay.
But in another situation where a lot of kids are graduating right now and they're getting acceptance jobs, letters, the minute they leave college and start that job position, that's history. That's actually considered work history. Okay. So people coming out of college can buy a house, but they have to have a job in place that complements their degree that they just completed. Okay. So there's different ways that what I want people to do is make sure they understand what their income is for the year, know what their taxes and insurance, and know their job history, work history, and income history for 2 years.
Okay. Now what happens if they change jobs? Is that held against them if they switch jobs?
Well,
even though the income may be the same, but say they totally 2 different types of jobs.
What I like to do is I like to try to create a work history for 2 years.
Okay.
And, some people have been unemployed for a couple months in between, and they went from one job, unemployment, to another job. What I try to do is take the application, put it all together, present it to underwriting first, and say, listen, will you find these gaps, or this gap, between this job and this job, but knowing that these two jobs are really, one's a manager of a restaurant and the other one is a radio DJ. They're completely two different industries. Will you be okay with that change of position? I like to try to get that done first, because then the sting is not as bad, getting the news back to them, good or bad, right away. Instead of taking them through a mortgage process where a lot of people know, and 40 days into the transaction, the deal goes awry.
Okay, so you're doing this in the pre-approval process.
I'm doing that in the pre-approval process.
Okay. And, you know, a lot of people have been laid off lately. How is a layoff affected? Let's say, you know, they've been, you know, had a job for 10 years, got laid off for a year, back with a new job. How does that layoff impact their ability to get a mortgage?
Well, I'm going to trail where their unemployment, how much unemployment they had. I'd probably say if they started a new job in the past 2 months and they were unemployed for 12 months, I'd probably wait a full year.
Okay.
Till they're into that job.
New job. Okay.
Even though there's a letter in place, HR, things happen.
Sure.
I probably would not be comfortable with them just being unemployed for 12 months and then suddenly have a job only for 2 and then coming to me for a loan. I think we would have some problems.
Okay.
Unless there was a significant amount of money down.
Okay.
30%, 40% down.
Right.
Making us feel more comfortable with the value to what the debt is.
Sure, and probably with the laid off, they might have used a lot of their savings.
Exactly.
So make it a little harder. And one of the things I was just thinking about, you know, as far as credit, you know, I have a buyer I'm working with now that have, you know, been working for a while now, especially when we're talking, you just mentioned about getting out of school. And someone getting out of school, a lot of times they have all their debt service in their parents' names. You know, they're living with their parents. The parents may be paying for the insurance. Maybe parents may be paying for their phone, or through their phone. You know, the parents' account for the phone.
Okay.
So they really haven't established credit.
Yep.
Okay. How does that impact, and what can they do?
Well, we need credit scores.
Okay.
So we need to see what their scores are. We then need to see what their debt to income ratio is, meaning based on what they're making, for every dollar they make, we need to stay under 43 cents of debt, taking on that new mortgage and whatever other debt they have at the time.
Okay.
Safe to say, if you're talking about a new graduate and they have a new job,
right. And no credit established.
Well, no credit and having credit scores are two different things. They have to have at least 3 lines of credit established to focus in on Fannie Mae approval.
Okay.
Can we use alternative lines of credit? Yeah, like a cell phone bill, potentially a utility bill if necessary. Okay. But we try to see if we can establish credit lines to have 3 valid credit lines. So again, it's case by case, and that's where a credit maintenance and repair specialist comes into play, where I would review the credit report from an overview and see if there's things that he would suggest that we could do immediately, so we could pick it up and recognize it, and maybe even rapid rescore and get those credit lines recognized.
Okay, so so basically, you know, for advice for someone just getting out of school is maybe go out and establish credit.
Don't run it up.
Right, but just get it established. So if they, you know, if they take out a credit card and they go to a store, they buy something and they pay it off right away.
That's great.
As establishes their credit.
And keep the limits under 50% of the total allowability. So if they have a credit limit of $3,000, don't go over $1,500 at any given time.
Right.
That's when you're maximizing your debt to income.
Okay. And then you said you can use alternative sources, maybe like, you know, a car payment. Well, yeah, a car payment or a alternative source.
It should be reporting.
Right. Like a cell phone, you know, bill. Make sure the cell phone's in their own name. Maybe the insurance is in their own name.
Insurance is a great thing, but we need to see that. We need to see that trail.
Okay.
And we can take those into consideration, because the insurance company obviously does a credit evaluation on the client too. I mean, they're just as sticklers when it comes to credit as mortgage industry.
Right. So tell me, you know, someone's out there, and you know, with the internet, there's hundreds, if not thousands, of lenders. Okay. And I always try to get my clients to work with somebody who I know, because I think a relationship and they have an obligation to me to be honest on things. But you know, how should somebody evaluate which mortgage company they work with? Okay.
Well, again, typically most people, you know, that are going social media, looking on the internet, they're 85% are looking at properties before they even call you.
Right.
So they're building out their team and kind of coming with you and just slamming it in front of you. In my experience, when somebody's looking to work with a mortgage company, they should try to work with somebody that is with a bank that understands that market and understands the realtor, if they don't even know them just yet, oh, the realtor works at Remax or works at Keller Williams or Berkshire Hathaway, and that they're in that area. Like, you don't want oh, my cousin's friend, he's a realtor, she's a realtor, and she's up in Scranton, and we're buying a house here in Newtown. That's not how you set yourself up. That's how you set yourself up for failure. Right. So what I usually suggest, and I'm sure you do the same thing, is meet a couple people in the area that are familiar with your surroundings, and they're going to best understand how to get the loan done.
Okay. So a lot of people I see, because they're doing all the searching in advance on the internet, start applying or getting pre-approved from all these lenders that are on the internet. Okay. Does applying for a lot of different loans, pre-approvals from different lenders, does that impact their credit score at all?
Great question. Inquiries.
Okay.
And the inquiries could work against the client if they're working with a mortgage institution or a federal institution, a bank, or a mortgage company. There's a law that is in place that as long as you're running credits for your mortgage, that it should not impact your credit, as long as it's done within a 3-week parameter.
Okay.
But if you're running your mortgage 3 or 4 times, getting a marker down at Atlantic City to gamble, opening up a Lowe's credit card, and shopping at Walmart and ringing up one of your credit cards all at the same time, it could impact your credit. Okay. When you're preparing to go buy a home, you need to be angelic. You need to be very under the radar and not using your credit a lot. If you're going to compare a couple or use the word shop a couple mortgage institutions, use 2 or 3. I wouldn't max that out. Don't go thinking about buying a car at the same time, because there's going to be inquiries if you're going to go get a car loan.
Especially a couple of dealers.
Well, I had one loan where it got denied immediately. It had 24 inquiries in one day at a car dealership. So that loan went away. Too many inquiries, and his credit dropped 60 points.
Wow.
Yep.
Wow.
So that's an example.
Yeah. So someone, they get pre-approved. They work with myself or another real estate agent to find a house. They find a house, and the process begins for getting a mortgage. Yep. What happens in that process?
Well, once I take the application and I really put together a good, solid financial resume, I then send a list of items that I'm going to need to complement that application.
Okay.
Whether it's tax returns, whether it's bank statements, whether it's W-2s and or 1099s. Now, if it's a 1099, that means they're self-employed. I'm going to need a letter from their CPA stating they're in good standing and that they filed their taxes for 2 years and they've been self-employed for 2 years. Okay. We can do self-employed loans, but they're documented. We need to see a consistency. We can't see a downgrade in the income over the years. We need to see a consistent manner of income. So those are and pay stubs, because the pay stubs are going to show us a year to date. They're going to match up with the tax returns. They're going to match up with the W-2s. Right. We're going to verify that information and the employment, and then we proceed forward.
Okay. And then there's so when they apply for a loan, there's an application fee. What does that cover?
Typically, there's not an upfront application fee. There would be an application or appraisal fee, really, upon consummating the disclosures that are issued for the client to review. Because somebody has to be responsible to pay for the appraisal. Right. So typically, it's going to be the consumer. That's usually one of the only exposed items that are required to proceed with us. Okay.
And then. In the pre-approval process, there's a different type of credit report ran than when you actually apply. You get like an in-file credit report. Is that still the case?
No.
Full credit report.
We do a full credit report, full poll, all 3 scores. And then we go over that with the client to make sure that it is them. Sure. Because sometimes they're like, that's not mine, that's not mine, and 9 times out of 10, it's theirs.
And then you get the problems with the junior and senior sometimes.
That happens.
The same name.
I always make sure that I really try to emphasize, hey, do you have a suffix on your Social Security card? Do you have? I don't use my middle initial, but is it on your Social Security card? Right. Is it on your driver's license? Yes. Then I need to use it because there could be an identity issue. Right. Or transposing a Social Security number or date of birth will cause some problems as well. It's happened.
Sure. And then after the appraisal is done, and you're going to verify income, right?
We'll verify income and employment.
Okay.
What happens is, as the appraisal comes back, it comes together with the rest of the file. It goes into underwriting. Underwriting reviews it, issues a conditional approval, some additional items that we might need, some additional bank statements or verification of deposits, things of that nature come into play. But we work through with the client to the closing.
Okay, you mentioned underwriter. Can you explain that a little bit more?
An underwriter, well, there's the loan officer. So we had a flow chart. The loan officer meets the client. So there's the consumer, there's the loan officer. The loan officer then puts the file together and then needs to be processed. So there's a processing department that I work with. The processing department and myself put together that file, stacking and packing and making sure it's all in a nice order that anybody could review it and understand the loan. It is then submitted to underwriting within about 5 to 7 business days. The underwriter has about 10 days to review it because they're also reviewing other files.
Sure.
And then they'll come back with their determination. Well, I can't give you the approval till I get this, this, and this. Or I'll give you the approval, but I need this and this to close. And that's how it works. And then we work with the underwriter to then clear the loan, to be approved, fully approved, to close the file.
Okay, excellent. So when people are shopping, a lot of times people want to shop for their interest rate, you know, and there's, you know, people will normally see like an interest rate and an APR. What's the difference between those two?
Well, the APR is the yield over the duration of the loan.
Okay.
The rate is the rate for that's compounded against the loan amount. So when a customer gets their closing, they see the APR, they're also given an amortization table. So it ties into the difference between the actual rate and the APR itself. So what is good is that a loan officer that's handling a purchase should be present at the closing so they can explain these items and show the difference between what the APR and the rate is. They're also provided in the disclosures originally, and typically we go over that with them as well.
Okay. And you mentioned about points. What are points? What do points do for?
Well,
you know,
there's good points and there's bad points.
Sure.
Right? There's good points. So, maybe you've heard the expression "buying down the rate."
Right.
Okay. Fannie Mae has requirements in the sense of pricing a loan, because then they won't buy it or accept that loan to be approved unless it has certain costs that were incurred into the rate. So, say the rate today is 4.25. But because the credit score is under 680, the loan to value on the purchase is only 5% instead of 10%. It's a 2-family instead of a 1-family. Fannie Mae requires the bank to charge the client in the rate. So say that those charges end up being a 0.5 point. Well, that 0.5 point could be rolled into the rate, where that rate now is 4.25 is now going to be 4.5. Or the client could pay down the rate of that 0.5 point and get the lower rate, and they're buying the rate down. It's not really a point, but it's a Fannie Mae charge where they could buy down to the rate where they want to be. So there's options, and that's the beauty of working with a bank, because sometimes broker bankers don't have those options of buying down the rate. They only have the rate to what it is because they have to make their yield spread.
Now, a seller could also buy down the rate for a buyer. Is that correct?
Well, they can give they can give closing cost credits. Now, in most circumstances, you're allowed to go up to 6% seller assist. Today's market, you can't maximize the 6% assist and be higher than the closing costs. So, say the closing costs combined are $8,000. You can't get $8,200 in closing costs. You can get $7,900 or $7,950 technically, but you can't get $8,100. That you can't go buy whatever the closing. You got to follow the closing costs. I have a situation right now that the closing costs, once we have the final numbers, is going to be our determination of what we're maximizing the closing costs are, because we're allowed to go up to 6%. But we have to wait till we have the final numbers.
Right. And so, you know, how much money do people need to put down? Like, say, you know, there's a term called private mortgage insurance, you know, and that's where a buyer's putting down less than 20%.
Correct.
Can you go over, you know, what private mortgage insurance is and why they
Another
have it?
great direction of where the market's going in the past 6 months. FHA was in a lot of trouble. They stopped allowing you to write off the mortgage insurance. And now it's permanent on the loan. Well, conventional came around and said, listen, if you can come with 5% down or be gifted 5% down, you'll have only mortgage insurance for 36 months or 78% loan to value based on the value of the home, as long as you have 20% equity in the house. We also have a 3% program out there, but they're primarily portfolio product under the conventional. They do have a slight MI. They're marketed as if they don't have MI. Yeah, they don't have MI after 36 months and or the 78% loan to value. So conventional financing is pushing a lot of programs out there with either little or no mortgage insurance. And the reason why mortgage insurance exists is because there's so less equity in the house. When somebody's buying the home, there's more risk for that property to potentially foreclose. So that mortgage insurance covers that foreclosure potential.
Mm-hmm.
That's covering the bank's exposure to financing that loan.
Okay. You mentioned like Fannie Mae, Freddie Mac. What are they? And why are they involved?
These
are
your
you selling them the loans? What are you doing?
The best way to look at them is if you're in a warehouse and there's 20 different publishers has books in the warehouse and they're being set up to be distributed. The distributorship of that warehouse is the distributor, and then there's 20 different banks.
Okay.
And there's 20 different publishing companies. Well, Fannie or Freddie distributes money back and forth between those banks.
Okay.
Whether they're Freddie approved or Fannie approved. I've seen more banks being happy to be more Fannie approved than Freddie approved because there could be issues with Freddie loans. With Fannie, it's a more common practice. So just hypothetically, we all have our own fulfillment shelf within this distributorship that we're allowed to sell the loans to Fannie Mae, and then Fannie Mae could sell it to whoever else would like to buy those loans. So it's kind of a feeding system. That's what they're set up for. And they regulate the loans to be, hopefully, compliant.
Right. So you use the term Fannie Mae, Freddie Mac. What does that mean? Is that short for something, or is that the actual names of them?
Gotta tell you, I don't have the answer for you.
Okay.
And you know what? I learned from a very smart person. If you don't have the answer, I'll get it for you, and I'll find out for you the next time I talk to you.
All right, terrific. When a buyer makes a mortgage payment, what's included in that payment usually?
It could go two ways. It can go with where they just pay the principal and interest payment.
Okay.
Where most people, if they have a more of amount of money to be put down, they prefer to pay the taxes themselves or insurance for themselves. Now again, some people like to have the insurance separately and not escrowed in the loan because they own other properties and they're blanketing an insurance policy or an umbrella policy. Okay. So it's a case by case. I have something like that right now where the gentleman wants to refi one of his houses, but he's a blanket on 20 other properties. So it doesn't make sense for him to escrow. Okay. There could be a change in the rate against you for not escrowing taxes and insurance. Okay. First-time home buyers is typically a requirement because there's really no equity in the property. No mortgage company wants to have the taxes in first position and the mortgage in second position.
Okay. So basically, then what they do is, so the tax entity will come in first position if there was a foreclosure.
Exactly. So what happens is they really look for insurance. They look for a client to prepay a year in full. Okay. And then also escrow for the amount of months for the rest of the year. Okay. So it gives them some room on insurance. Taxes is typically for the rest of the year. So if we're closing in May or June, there's 7 or 8 months left in the year.
Okay. So, Joe, there's a lot more questions I had for you today, but, we'll have to do this another time. I know, that'll be part 2. And I forgot to mention, Joe, you have a show here on Talk Exchange Radio also,
Real Estate Radio Network, where we all brought it together and brought Bucks County Homes and Living now. So,
yeah,
I mean, it's a growing radio station. Keith Reynolds, the producer, has put together some great dynamic speakers, and I'm glad you're on board. I mean, I'm sorry I got bumped for Elmo last week, but, things happen. You know what I mean? Definitely. I told everybody I was bumped for Elmo.
Terrific. And you're wearing your Elmo red today,
I got my red today. I got my green pen for the
Okay, excellent. And Joe, I want to thank you for coming today. And Joe, how can someone get in touch with you if they have any mortgage questions or if they're looking to get a loan or a refinance?
I appreciate that. My direct number is 215-290-5108. That's 215-290-5108. Or my email is jscorese, that's JSCORESE, at the number 3RDFed, FED,
Okay, terrific. I want to thank everybody for joining us today. Once again, my name is Paul Rosso with RE/MAX Properties in Bucks County. If I could be of any assistance to you with any real estate questions or any real estate needs, please give me a call at 215-778-9687. You can email me at paul@paulrosso, that's ROSSO.com. And, or you can follow us on Facebook, follow the show, follow myself on Facebook at Facebook/Good Life Bucks County. And also at Facebook/Expert Advisor. And, follow us on Twitter at Bucks County Live. And my website is buckscountyandbeyond.com. So next week we have Trish Fritz. Trish is with Properties Abstract. She's going to talk about what happens at closing day, how to prepare for that, what actually takes place at the closing table. And she's also going to talk about the various title issues too. And in 2 weeks we have Michael Abankovich. He's going to be discussing about antiquing in Bucks County, so that sounds like a pretty exciting show there also. So have a great week, everybody, and we'll see